Hi, this is Nadeem Keshavjee with Greenburst Capital here. Today we'll be talking more about the MLI Select Program with CMHC for multifamily properties in Canada. So what is the MLI Select Program? Before we dive into that further, let's talk about what CMHC financing has traditionally looked like. And then we can layer on the MLI Select and what changes it's resulted in. So in concept, CMHC has had a program for many, many years where they provide a form of insurance for mortgages. Similar to homeowner mortgages, where a first-time home buyer can buy a property for 5% down, CMHC also exists in the multifamily segment, where investors can also obtain mortgages for multifamily properties. Now, over the many years that this program has been around, where CMHC has provided insurance for multifamily properties, they have traditionally provided leverage of up to 85% loan to value and amortizations of up to 40 years. Because, as I mentioned, CMHC is providing insurance for these mortgages, they're not actually lending the money. In order to provide insurance, the exchange or the other part of that transaction is an insurance premium. That insurance premium can be added to the mortgage amount so that it is not due and payable up front. That insurance premium has typically been up to 5.25% for CMHC's standard program. And as of June 19th, 2023, that maximum premium is going up even further to north of 6%. Now, when CMHC introduced the MLI Select Program, they did so because they wanted to encourage three key social outcomes. Those social outcomes are affordability, energy efficiency, and accessibility. Those three key social outcomes are affordability, energy efficiency, and accessibility. CMHC, via the federal government, wants to encourage these three social outcomes in order to promote these three areas. For affordability, CMHC wants to promote affordable housing, or the prevalence and increase of affordable housing in Canada. For energy efficiency, they would like to encourage more properties to be more energy efficient, either being built more energy efficient or improve the energy efficiency of existing buildings. And finally, accessibility, to encourage new buildings to be built more accessible or to convert existing buildings to be more accessible as well. And so the way CMHC has designed this program is to promote different levels of affordability, energy efficiency, or accessibility, and allow people to mix and match or choose different levels of depth of each of those social outcomes in order to get certain benefits in return. The more energy efficiency, accessibility, or affordability somebody provides, the more benefits they obtain in return. So, what are some of the benefits of the MLI Select Program? Well, these benefits can be obtaining up to 95% leverage for your property, obtaining an amortization of up to 50 years, getting lower insurance premiums as low as 1% prior to June 19th, 2023, going up to 2.5% after June 19th, 2023 as the lowest level of premium available. And finally, lower interest rates as well, especially if somebody is committing to affordability and is selecting to have a 10-year term. Interest rates are lower for those mortgages than they are for standard CMHC mortgages, which again is lower than conventional mortgages to begin with. There are some other benefits as well that are more nuanced, one of which is rental achievement may not be required for new construction properties. In other words, a specific level of lease up may not need to be in place for newly constructed buildings or buildings that are being newly constructed. And finally, recourse may be limited. In the event that somebody gets 100 points for affordability, they may not need to provide an outside guarantee. That being said, the requirement for net worth is not waived in the event of non-recourse financing, and the borrower company itself that is borrowing the funds needs to have an additional net worth of 25% of the loan amount.